Greetings, Michael.
Hello, Carl. How are you?
Good. Now, hey, wait a second. What over your right shoulder, is that a small Lego Kitces? What is that?
Yes. This was for those who can't see, I am holding up basically a small Lego me. Yes, this shout out to the folks at Yori Folio who had made I guess they were doing a show where they were giving out these little Lego style dudes. So he's a USB drive, but they painted him blue and scribbled on the goatee. So I've got little Lego me. So I have to keep little Lego me as a memento now. Oh, now I got to skin him up. All right, come on, little guy.
Well, I don't think there's any way for me to use that as a segue, but it's good to know what's in the background. So here's the question I have for you. I have a dilemma.
Okay.
And this has come up more than once lately. I get asked a lot for referrals to, well, that's not the way people do. People email me a lot looking for a financial planner.
Okay.
And what's coming up more often lately, it's always come up, but it's coming up it's almost every time. And in fact, just happened literally yesterday. Having a conversation with somebody. It was a series of conversations. So it's not like people just walk up to me on the street and say, I have $12 million, but it was a series of conversations with someone who has $12 million of investable assets, net worth of probably closer to 20, 12 million liquid, relatively, I mean, there will be some heavy lifting up front from a tax perspective because of some things that have happened. Has a pretty simple view of portfolio management, is already it has a Big Five accounting background.
Okay.
They manage their own money for a long time in a passive, well-designed portfolio. So they were sort of evidence-based investors, but she needs advice. Again, Big Five accounting background, knows her way around money, all that stuff, but needs advice. It's a bit much for her to be dealing with. And she needs advice and she's willing to pay for it. In fact, she even said, why can't I find, so she's been looking for somebody that she can pay for advice. She doesn't want, she's like, I don't understand. The portfolio design and construction is pretty close to a commodity at this point, in her words. I can go to Wealthfront. My money's already at Schwab in their private client thing, managed passively. I can go to Betterment. I can do all these other things. And that's what all the books point to. This is what she's saying. All the books point to, there's a way to manage money here. Mm-hmm. I got to make some big decisions about big asset allocation decisions, of course, just based on a plan. But what I really need is the tax and the estate planning and then somebody to help me stick to that asset allocation based on my plan. And everybody wants to charge me. They all call themselves, they even have in their names sometimes their title, portfolio manager or head of chief investment officer at this RIA financial advice firm. I realize that's an important piece, but it feels like a commodity to me. I want to pay advice. And she's like, I'll pay $25,000 a year. I'll pay a $25,000 a year retainer for advice. She said something that has been said to me 100 times over the last 10 years. It seems like all of you are charging for the commodity and giving away the valuable stuff. In other words, you're charging for portfolio design, asset allocation, and you're linking your fee to that. It's directly linked to that. And then you're giving away all the really valuable stuff around planning. So I was like, okay, so I started reaching out a bit. And it's hard to find somebody to send her to. Somebody with real technical planning chops. Oh, by the way, she'd also like a team. So that it's not a solo advisor that disappears off the face of the earth. If something happens, right? She likes the idea of okay, well, there's more than one person there. it hasn't been easy. And I've done this experiment. I do this experiment a couple times a year. What do you make of that? Like, what is that about? Or am I missing? I'm sure I'm missing something, but what is that about?
So I think there's a lot of different interesting stuff going on there. So at the most basic level, I kind of think of this and boil this down to it's a fee issue. It's a how much does advice cost issue. Because look, at the end of the day, 12 million investable, advisors have breakpoints and such. That's probably still a fee in, I don't know, the 60 to 70 basis point range, maybe with the different breakpoints that we've got. It's like some AUM advisors probably charging, call it $70,000 to $80,000 for that client. We'll call it 75 just to make the math round. So to me, like at the purest level, what we're essentially talking about is she doesn't want to pay 75 grand. She wants to pay 25 grand. She doesn't want to pay 60 bips. She wants to pay 20 bips. And so then just you get to the question like, well, why aren't there more advisors who will charge 20 bips on a big portfolio? And to me, like this gets into sort of two different things that get to be interesting challenges at the same time. On the one hand, like as you noted, like not a simple situation. I mean, it sounds like there is some complexity here. There are some challenges. We need not just an advisor, but a team. So just, I got to pay for not just one expert, but like an expert and a backup expert on the team who has enough expertise to cover for the first expert if something happens. Like you're hunting for a fairly sophisticated, experienced advisor and firm and team capability. And so when I hear this at the most basic level, like I know a lot of people are probably hearing this and going to a AUM versus flat fees model discussion, and we may end up there in a moment. But to me, the purest essence of this is just I have $12 million in a lot of complexity. I want to pay someone $25,000, but everybody's charging 75.
Yeah, interesting. Are you saying that's not the right way of, because I agree, like I immediately am like, well, wait, you're just linking it back to portfolio, but
if the advisor came to her and said, you know what, we'd love to work with you. We only charge basis points. That's the only way you're allowed to work with us. Our fee is 10 basis points. Would she complain?
No, because the fee comes like she doesn't have an AUM problem. She has a fee problem. Interesting. Super interesting.
She'd be totally fine at 10 basis points. If I said the fee is 20 basis points, she's like, oh, well, funny thing. I got 12 million at 20 bips. That cost 24 grand. I was willing to pay 25 grand. So I'm totally cool. Like, I don't view that. It's not a basis point problem. It's just I don't like the fact that this adds up to 75 grand. I was prepared to pay 25 grand.
Yeah, there's so many interesting things about that. I love that line of thinking. And there's so many interesting things about so one thing we could put a pin in and maybe we would get to is why are we still taught like let's assume 75 is, but let's assume 75 is the number that an AUM advisor would charge. Why are we still linking it to, look, this is probably a whole nother discussion, but I guess the reason we're still linking it to portfolio size is because it's some arbitrary measure of complexity.
Yeah, it's a proxy for complexity. It's clearly not a perfect proxy for complexity because we can have some very affluent clients who are simple and we can have some more modest portfolios who still have a lot of financial complexity in their lives. But it's a better proxy for complexity, I think, than we give it credit for. And frankly, there are a lot of things that our industry just does automatically already to further reconcile that. We have breakpoints, right? Like It's not like I've got the same fee for most firms, at least. It's not like it's the same fee on the 12th millionth dollar as it was on the first million, right? Like it starts breaking off. So we tail it off a little bit. A lot of firms have some kind of client segmentation. You know, if my average client is $1 million and you bring me 12 million, you're probably going to get more services. I'm answering your phone faster. You get the best advisor, you get the best experts, you get more service hours, our client events, our other fancy stuff, our concierge service, whatever we do. Like a lot of firms have some kind of ways that they either formally or informally segment their A clients or their top clients from the rest, which is another way of saying, you pay me a much larger fee than my average client, I'm gonna bring a little bit more to the table for you. Whole other discussion about whether we necessarily offer our A clients the things that are actually most valuable to justify it. But conceptually, we segment our services. We tend to do more for the A's than the C's. We tier our fees. We charge at least incrementally, marginally less for the A's than the C's. Bigger fees, total fee is still bigger, but the breakpoints start kicking in. So like we start to equalize the playing field. I realize it's not perfectly equalized for every client across the board, but you know, the truth is I think our services tend to gravitate more than even most of us realize. I mean, we all talk about the fact that like, you know, my $10 million client doesn't take 10x the work of my $1 million client. So why would I charge the 10x the fee? And I talk to a lot of firms that say that. I'm like, oh, so your average client's $1 million? Like, yeah, that's about it. Like, cool. How many $10 million clients do you have? And usually it's like, you know, kind of like 3. And I'm not knocking someone at that size, but just, you know what, when your average client's $1 million, most of your services are built for clients at $1 million. And you don't actually attract as many clients at $10 million because your firm's services are kind of structured $1 million. The firms that work with clients that have $10 million end out attracting a lot of $10 million because they build services and models that are built well for $10 million clients. And then they don't actually get a lot of $1 million clients because they would have to have higher fees and more costs because they would need to charge more and have bigger minimums because they've got all these services that they provide that they don't know how to scale back for quote unquote small people who only have $1 million. So you see a lot of firms that work with the ultra high net worth that tend to have much higher minimums because they just do a lot more stuff for everyone, or have a lot more expertise or bring a lot more to the table or whatever it is. So, you know, we knock a lot this whole, why would my client with 10x the assets pay 10x the fee? But the reality is like, it's not like there are a lot of firms out there where 50% of their clients have 1 million and the other 50 have 10 million. And this is actually coming up regularly. We actually tend to get in a narrower range. Now, granted, the $3 million client pays 3x the $1 million client, and there's might be a lot of firms that have that, or the 750 grand client pays 3x the 250 client. And you might have a good number of clients in each of those buckets, depending on what your firm size is. So there's some narrower range around this where those fees probably don't align perfectly down to the client, but just it's tighter than we give it credit for. Most firms' client bases on average are more homogeneous than I think we actually give them credit for. And, you know, just, I mean, to me, like there's 2 ways to look at the market in the aggregate. Option one is 99% of consumers who hire a financial advisor are idiots who can't do math. Or option two, they're actually quite comfortable with how this works. They do the math and they're okay with it. And like, we're just beating ourselves up for the sake of beating ourselves up.
Yeah. Let's talk about that for a little bit, because I'm curious about it, because I've been thinking about this for more than 15 years, because about 15 years ago, I had an experience with a client who like wanted me to kind of break this down, right? It was a huge, you know, it's $50 million. And I reported to the board once a quarter. Right. So it was a
so like the client was so large, he had his own personal board. You had to.
Well, this was sort of like it was like a pool of money for a business, but the business was owned by one person. So it was like,
okay.
So I'd go meet with like 3 or 4 people that made up the board of directors of this business. Yep. And I would report once a year. And after one of the meetings, the founder of this company, who I also managed like 12 million of his personal money, was like, hey, would you just walk me through, you know, this pool of money? What do you do? Like, well, we built this beautiful portfolio. Like, it's all based on your like the sort of risk tolerance and the use of the money and, what return you need to earn based on the goals and all that stuff. Spending policy, essentially. We built that, and then I come every quarter and I report to you guys. You're like, oh, how long are you here? I'm like, about an hour. And at this point I caught on. So I was like, his name was, I'll just mention Phil. His name is Phil. His name wasn't Phil. I was like, Phil, I know where you're headed with this. So I said, there's some prep work. And then afterwards I got a report. He said, add all that up for me. Like we added it all up, and he was like, that's $10,000 an hour, like some number like that. And
did you tell him he's getting a deal because it costs more for an hour speech?
Yeah, I said, try booking me for a keynote. I was like, no, I didn't. And at that point, I wouldn't have been able to say that. So, but that was well played, Michael. We obviously I had all sorts of things I could talk about, right? Like the risk and the market, and it's not my job.
Our firm's liability exposure on a $50 million portfolio is significant. Yeah.
So I don't think I want to talk much about that. Like what I'm curious about is from that point on, I've been thinking like, and we have these people every once in a while that stick a flag in the ground and say, and I can't remember who that guy was. He was in California. He was $1,800. His retainer was $1,800. And I talked to him once, and he had just brought in something like a $75 million client from Goldman. He was an ex-accountant, and ex-tax attorney, and the way he made his decision was he took the top 10% of billable hour attorneys in his zip code, and he charged that.
Yep.
And he would calculate every year, and his average retainer was like $1,800 to $2,400. I'm sure you may even know who I'm talking about. I can't remember his name, but we have these people that make that noise every once in a while. Retainer, flat fee, decoupled, and it makes sense, and we like, oh, that makes sense.
Yeah. So let me ask though, Carl,
do you think that fear is overblown?
After you had this conversation with Phil and he did the math and he figured out you're charging him $10,000 an hour.
I don't know. Yeah, something like that. Yep.
Did he fire you?
No. I mean, I ended up firing him 2 years later because he said to me, Carl, your job's so easy. All you have to do is sell before the market goes down and buy before it goes up. And I said, oh, now I understand why we've had so much frustration working together. But he didn't fire me because of that.
So why didn't he fire you after he figured out you're charging $10,000 an hour?
Because we were actually super competitive at that spot, right? Like it was priced if he went and compared. So this is the conclusion I always come to, is we can sort of debate and harangue and feel bad or feel guilty or feel awesome, but largely the market gets to decide. And I think that's what you're pointing to my earlier example is the reason I'm having a hard time finding somebody to refer this client to is because for the service she needs, people charge more like $50,000 to $75,000 a year.
Well, not just that. I think the problem is the people who are delivering at the capability she wants are getting other clients willing to pay $50,000 to $75,000.
And in many cases, a line of them called a wait list.
Yeah. And she's getting outbid. I mean, you said you had trouble finding awesome advisors. Like, what was it because you couldn't find them, or is it because they didn't, like, you couldn't find anyone who could do the work, or you couldn't find anyone who had the room to take her because they had wait lists?
Yeah. And I should be careful, right? Like I have found some amazing advisors / planners that do incredible work at 25,000 and less. Amazing. Yep. But there's always one reason why it doesn't work, right? Like it's either geography, it's not a team, it's maybe there's a specialty that's just adjacent, but not the one. So like, it's so again, I want to be clear, like a couple of advisors have reached out and I've been like, oh my gosh, these people are, this is amazing. Yeah. But it's not a fit. So I'm having a hard time finding a fit. And the people that there has been a fit with, to answer your question, the people that there has been a fit with, well, there's two reasons why the people that it has been a fit with haven't worked. One, they were mostly solo.
Mm-hmm.
And she really wants to know that there's more than one person.
Yeah.
And 2, they have a wait list.
Which to me just comes down to like, so the perverse reality to me of the advisor marketplace is there aren't enough good advisors for the clients who want to pay for services.
Right.
Which at the end of the day is why she can't find a good advisor when she's ready to write a $25,000 check, because basically those advisors are getting gobbled up by firms. Those advisors are getting gobbled up by clients who are still willing to pay basis points, which is coming out to $75,000, which just basically means she's losing any slots to be a $25,000 paying client because clients paying $75,000 are already taking those advisors. And she's getting outbid for limited services. Now, I'm sure there are people who are listening to this as well, and you're going to get emails from them, Carl, because you brought this up, who are going to say, I want your $25,000. Like, I want your $25,000 client. Maybe they've got the top. I've got a team. We're all CPAs. We know our tax stuff cold. This would be an amazing client for us, Carl. And, they may reach out and you may send it to one of them. But it's so hard. Like the irony of this is there are more clients who are willing to pay healthy fees than good advisors to service them, which is why when you get a situation like this, all the advisors like have wait lists, you can't find them. Yet as an individual advisor, it's still so darn hard to get a client. It's time consuming. It costs a lot in marketing, sales, networking, COI, like whatever the strategy is that we do. We did a study on this on the site. The average advisor, when you consider their time, the cost of their time and the cost that they actually spend on marketing, the average advisor spends more than $3,000 just to get one client. Mm. And that's the average across all clients of all different sizes. You get up into the higher net worth. We didn't actually break it out directly by net worth, but I suspect you'll probably find a cost north of $10,000 of just the sheer amount of time and work and marketing and trust building that it takes. Because, a lot of people come at you if you got $12, $20 million. So it's really hard just to get on their radar screen, to get in the door, to be competitive with them, to get them in. And the sheer marketing costs of it means, if you're going to have to do all that work, take all that time, build all those relationships, do all that marketing spending to get a client as an advisor, like, why would you take the $25,000 client if you can get a $75,000 client? Like, if you're good enough to market and move in circles of people that have $12 million, why wouldn't you take the ones that are willing to pay more? And when you do, all your seats get filled up.
Right.
And then you're like, why would I take a $25,000 client? Because I'm getting other people that are willing to pay me 70. And frankly, if other people want to pay me 70, I don't want to pay what take you for 25. Because if the word gets out, you're going to cannibalize the rest of my business. And that's not so good for my business. So like, I've already got people who are willing to pay more. And so I think there's this combination that, the number of good advisors are scarce, but there are a lot of advisors. There are a lot of not so great advisors. There are a lot of people who put advisor on their business card, but aren't even actually in the advice business, that our trust is so low with consumers that it makes it really, really hard to get a client. It makes it really, really time consuming to get a client. It makes it really, really expensive to get a client. And so, frankly, from our end, I think it's nothing nefarious, justified. Like, if you can get one, you charge what the market will bear. And what the market will bear is, what that AUM client is paying, what Phil was paying you, where you were charging the equivalent of $10,000 an hour, and you were very competitive, and he didn't fire you for it.
Yeah, it's crazy. So it's a really, really fascinating. I was just thinking through, like, okay, so let's pretend like this client with $12 million knows how they want the money invested. So they could just plug it in at anywhere, right? Let's just say Vanguard. They could just plug it in at Vanguard, have a portfolio built.
Yep.
But they really need it's really just like, it's like thoughtful tax advice. It's thoughtful estate planning. And I was like, okay, well then go find an attorney that does that. And then I realized, like, or an accountant that does that. I'm like, well, the problem is all the accountants I know that do that, quote unquote, do that. Most of the accountants I know don't have time to be that strategic because they're reporting quickly on the stuff that's already happened, right? Like they don't have,
Right.
So the ones that are really thoughtful and strategic largely have become advisors. And so like, you know what I mean? Like the really, like, where do you get the thoughtful, strategic tax advice? Because I think of like the attorneys that provide thoughtful, strategic tax advice. Well, it comes with monuments crafted to themselves and 15,000 things and some life insurance policies and right. Like it, like there's just, it's a really interesting nut to crack.
Well, but I'm curious, so when you just got down to like, okay, well, why can't you just, your friend needs whatever is if 50 hours work of advanced work at $500 an hour, costs $25,000 a year. So, why wasn't someone just charged $500 an hour out there? And, to be fair, there are advisors out there who are charging $500 an hour, or even less. But the challenge for so many of them is it's hard to get enough clients. Really, like if you're going to do this,
right?
And, this is 50 hours of billable work, and you're trying to fill, like 2,000 working hours in a year. You can't bill for all of them, but maybe you bill for 60% of them. It's like you're trying to fill 1,200 billable hours, which means you need 24 clients like this to keep your roster full. Who has time to market enough to get two $12 million clients a month while also doing the 50 hours a year work for everybody else?
Right.
And I mean, the answer is like, not many. I mean, just, that's a lot of client. Like it's a lot of clients. That's a lot of $12 million clients to find every month on an ongoing basis to fill up your year. Even, just air quotes, like just charging $25, charging $500 an hour. I mean, to me, in the essence, like that's why hourly firms struggle in general is you need so many you need so many hours, you need such a volume of hours. But if you actually spent all the time to do the marketing in order to do that, you wouldn't have any time to do the work that you built the hours for. Yeah. And you get stuck. And so, like what ends out being the solution to this in the aggregate? Recurring revenue models, otherwise known as AUM, although to be fair, like her retainer structure at least gets you part of the way there. And the advice ends up costing more because it takes so much time and cost to get a client. I mean, in the aggregate, that's why I view issues like, fiduciary standards is so important, right? Imagine how different this business would be and how cheap advice would be if people confidently sought out advice and just took the first or second advisor they talked to the way that you go find a doctor when you're sick. We don't find a doctor by searching online and finding resources that explain the 22 questions to ask your doctor to vet their services and their fee model and how they charge you and all this other stuff where you're just like, my elbow hurts. Do you know how to help my elbow? Right. And we have this giant list of questions that are basically all about how to spend hours and hours and hours interviewing advisors to make sure that one is not fleecing you. And, important thing, because some of them unfortunately will, but, it makes it daunting for consumers. They don't want to take the time. It makes it hard for us. It makes it a super time intensive and labor intensive for any match to ever get made, which just flat out drives up the cost of getting clients so much so that the fees go up. Like, why do so many firms end up having minimums of a couple $100,000? Because they end out with the client acquisition cost of several $1,000s, which means it takes them the first year's fees to make back the time and the labor to get the client.
Yeah.
Like it's the difficulty of getting clients in the low trust the industry that drives up the cost of advice. And you see it reflected in the aggregate in situations like your friend.
Yeah.
Because, I'm sure there are one-off advisors who are listening who are like, Carl, I will so service the bejesus out of that client for $25,000. I'm like, more power to you. But if I said for most, I'm like, awesome, sounds like a great business. Could you find like 20 or 30 more of those in the next year or two? Most advisors are like, I would love the gift from Carl, but I don't know where to find 23 more of them.
Yeah. It's like the equivalent of me when I tell my wife, when I come home from a speaking engagement, what the fee was, it's the equivalent of her saying, well, geez, you should just do 2 of those every day.
Yeah.
Yeah, like, yeah, of course, that would be, I could just do, how about I just do 1 a day? It would be just fine, right?
But you got to find that many events and just, like the marketing, the work of it,
right?
Quickly gets challenging.
Doesn't work. Amazing. Yeah, it's really fascinating. And I do want to sort of just, as we wrap up, just want to emphasize, like, I had a number of firms reach out and I was like, actually blown. I'm really glad I went through the exercise because I was blown away at the caliber of work that's being done by people. And the only reason it hasn't worked so far is either A, location, or B, team.
Yeah.
And so we're going to continue, but
that's, again, like, that's how hard it is for you to find someone to refer her to. And the industry and how to navigate it.
I know. I've been telling people that. I'm like, if you think it's hard for like us to navigate the industry, try from the outside. Like this is a smart, intelligent, successful woman saying, what is going on? Right.
I know a lot of advisors that don't want to refer out clients who aren't a good fit because they're afraid they won't be able to find an advisor who's a good one to refer to. And like, I totally get it, but like, so imagine what it's like for a client trying to find their way to you.
Totally. Amen. Well, that was a really fun discussion. Thank you.
Awesome. Thank you, Carl.
Okay. See you, Michael.